Okay, Monday, the 11th of March, 2024. This is the week ahead, brought to you by Financial Juice and Earn to Trade, a great funded trader platform. All right, let's get into it. Okay, here we are, Monday. Let's have a look at what we have on the docket for the week. Nothing really going on today, Monday. However, Tuesday, getting CPIs out of Germany coming through there. And the big stuff that we're waiting for this week are the CPI readings out of the US. Year on year set to come out at 3.1%, in line with the prior. Obviously, a deviation from this is going to be hotly traded, I think. Now, the clocks have changed by an hour here in Western Europe in GMT Ville, if you like. So everything is shifted back an hour this week. All right. So markets, equities are going to be opening at 1:30. Oil will be opening at 1. Gold 20 past 12, and so on and so forth. All right. So just be aware of that, and that is for 10 days. And this is probably my most despised time of year when I have to change a lot of the time settings on my chart. Anyway, moving on. Wednesday, DOE, as per usual, Department of Energy readings there at 2:30 to come. Really, these readings are not what they used to be in terms of having like a multi-day impact, unless they come out like at a huge deviation from the expected. But nonetheless, they do provide fantastic sort of momentary mispricings on the market, where you can get some really great trades in the day time frame on DOE. I've been trading this for 6 years now, DOEs, and it's not for the faint-hearted. And I think you want to be careful if you're not trading for more than kind of 3 years. If you're going to be hitting a DOE piece of data within 15-20 seconds of the data coming out, you really want to be careful, because it can wipe you out. You got to have your OCO orders and your stops, etc. Just a bit of word of wise there to people. And then Thursday, core retail sales and initial jobless claims and PPIs all to come, and the retail sales all to come there out of the US on Thursday. If you ask me, I think Tuesday, tomorrow, is going to be the best day to get a trade on, and really the impact of what will happen here tomorrow may then be pervasive throughout the rest of the week. Obviously, core retail sales are going to be interesting, set to come out 0.5%, prior negative 0.6%. However, the most interesting piece of data coming on Thursday is the initial jobless claim, set to come out 218, prior 217. And any adjustment on the prior there will be quite interesting, given that we had a revision downward on NFP last Friday. While the jobs market does look good in the US and the economy is doing great, you just want to be careful that if the economy starts to not look so great, that could be a little bit of a cause for concern for equities on these really strong highs that they've been on. But anyway, then Friday, nothing of note really happening on Friday, and it's probably time to clock in for the long weekend there come 9 a.m. on Friday, and just head for the hills, lock it in for the week. But moving on to a couple of items that we're looking at here that I've been looking at. All right, Chinese oil demand growth set to slow as sales of EVs and LNG trucks climb. So this isn't so much really a tradable event. Like we can talk all we want about what's happening in the market here and there, but we rarely really get a tradable event. And for me, and a lot of the guys in Duggan Capital will tell you that really the only tradable event is a breaking news or breaking economic data event, where you can kind of get a temporary mispricing in the market and get into a trade and then sort of ride that thing basically. But this is a big story, and it could provide quite a bit of weight to oil for the pullback. I am short the front month spreads at the moment on oil. We're out of kind of the seasonal longs at the moment, and we're playing shorts here in Duggan Capital on the seasonals in the front month. So I do see a pullback in oil coming in, notwithstanding escalation of the situation in the Middle East or in Ukraine, more so in the Middle East. But I just thought this was really important to note, because there were green shoots coming through for the oil market last week, where you saw China Chinese refineries kind of kicking on and gearing up essentially for their version of the summer driving season and spring summer driving season. Okay, but that doesn't necessarily mean that the bid will be pervasive and maintain on oil. And another story that I'm not including here because we don't have time for it, but China has found a massive amount of offshore oil, which I'll probably cover this in next week. So there's a couple of headwinds there for oil demand to kind of bounce straight back in China. But you're seeing there's huge adoption here. Have a read of the article for exactly sort of how much adoption there is in China. But you're looking at, for example, EV sales and LNG powered trucks. Are having an impact of shaving 10 to 12% off the country's demand for gasoline and diesel just this year. Big hard numbers to come there. All right, we'll leave it there. Another thing here to look at is essentially, this article is actually sort of about well, it's really just about the risk of volatility coming back into the markets. But coming in, a lot of people basically piling into the bonds, a little bit scared of what may come in the forthcoming CPI reports, in that we may see a reinflation coming into the market, mainly led by Supercore, which we talked about last week. But I just thought this is a really good article to read for seeing where the bonds may be headed. And I don't think anyone is scared now of, are they in too early or too late in the bonds. I think people are just going to keep going in here. But another thing to note is Reddit this week are seeking to go public with a planned IPO coming out at about $31 to $34 a share. Not really a big market mover, but some people might want a piece of this IPO. So just have a read of this for timings and when they're going to plan to come out. I'm actually really late to the Reddit buzz, to be honest, but I like it. I like it. Okay. Here's one of my favorite topics to talk about, and that is the VIX and essentially Volmageddon, and how the market loves to kind of short volatility, i.e. short the VIX, when they think everything is just kind of running smoothly and markets are going to stay quiet. Now, personally, what I want to talk about here is this is a really good article to read. And then for me to, I want to say that this is all fine and dandy, people being short, like big time short VIX. And, as volatility decreases and equities move further to the upside, you're going to get paid out on that trade for sure. And if there are little pullbacks, people will martingale into that VIX and sell it down a bit more. I actually sort of really started professionally prop trading in late 2017, early 2018, and I went straight into the baptism of fire, which was Volmageddon. And essentially to sum it up, what happened in Volmageddon was there was a spike in the VIX, and that triggered ETFs to sell stocks because the VIX was over a certain level, and there was an algo on a lot of these insurance portfolio insurance portfolios, as in ETFs that were there to offer portfolio insurance, right? So these ETFs, so when VIX spiked, these ETFs started selling and liquidating, which then had a feedback loop into pushing the VIX even higher. And then that caused more looping selling in these ETFs, these stock ETFs and these portfolio insurance ETFs. And so you see this sort of echo chamber of shit went on for about a week. And that's when I sort of really started fully professionally trading prop at firm. And it was incredible to watch. Even through COVID, I've never, ever seen markets move like that again since. You're talking about the Dow, during the pit session would move, you're talking about 200, 300 ticks in probably half a second. It would just be washing up and down. And if you were sitting out there with limit orders, you were just getting wiped out all over the place. And it was a hell of an experience to watch. But what I want to come back to on this article is that this is really noting that billions are pouring into these ETFs, which basically short the VIX and sell volatility, short volatility. Now, this to me is sort of a canary in the coal mine and saying, well, hold on a second. If so many people are selling or are selling down on the VIX, it's just a matter of time before that gets blown out to the upside. And if it does, be aware of that. What happened in Volmageddon in 2018, February 2018, is that there is a sort of an echo chamber effect there, and that actually can continue. That can happen again, not to the same extent, but it could happen again. And so what I wanted to note here is a little chart of the VIX here now. I mean, this isn't the all-time chart. I mean, you can see the all-time if I kind of go out here. Now, these are monthly bars that we're looking at here on the right of the screen. But what I want to show you is that obviously this 08 GFC high trend down to then the July 15th high and then trending down. And you can see what happened in February of 2020. We bid over, and then during March we actually had this lovely pullback at the start of March around the 2nd, I think it was. We had this pullback and then we bid up into putting all-time new highs around 85s on VIX. So the buying started to come in here actually around the 20th of February on the VIX to rally out and hold on the pullback here. But where are we now? Well, it's all quiet on the Western Front. We're below 15s. We're actually trading 13.34s on the VIX right now. So, it's all quiet in the Western Front, but this is a really good chart that I use all the time to measure where we are in terms of volatility and risk and how the market is pricing risk. And for a lot of the equities indices trading that we do here, we do have VIX charts up all the time and to know where they are. So just keep an eye out for that. I'll post a little link for this so you could have a look at the VIX there. One thing that happened on Friday is Nvidia saw a massive pullback. Now, it was about a 5.6, I think, percent pullback. Not too much to worry about really, because this thing has gone up. Nvidia has gone up 19% in 6 consecutive days. All right, now it's up about 70% on the year so far. All right, so what do you really care about? 5.6% pullback? It's no big deal. And sure, maybe it isn't a big deal, but we are actually below that right now, below that close in the pre-market. So it closed there at 875s. We're actually trading 862s in the pre right now. As you can see, I actually have a higher time frame VWAP up here, and what we're going to do in Duggan Capital is we're going to start to release a report using this sort of a measurement as to how valued we are on actually the futures market, but we're just going to use it here for Nvidia. And really, this thing will not find significant buyers coming back into the market until we trade 800s, basically 808, right? What is that? 805s right now, and that is one deviation on the average pricing for the year, i.e. VWAP plus 1. All right, plus 2 is at 929s. We don't really do much trading around the plus 2s, but we do like to get involved around the plus 1s, especially on futures markets. We're going to look at that on oil in a second here, but just be aware of that. This thing does need to take a pullback to at least 805s at the moment. So let's see how it goes. I mean, obviously, there's a lot of trade to come. Here is the pre-market right now, as you can see in orange here, in Nvidia. And so, yeah, I think we'll breach Friday's lows for sure. And actually, Friday's lows in the post-market was 850. So I think we could get below there today for sure. Just to kind of, we're just gonna leave that there. Then moving on, I'm not a huge fan of Game of Trades, but they do release these sort of bear porn videos, right? And you heard, if you've seen Jason's last couple of videos, he's talking about bear porn. And really, that is what Game of Trades is, posting a lot of these type of charts that look really quite frightening, to be honest. So you see here, the delinquency rate of multi-family housing is taking a spike back to 2012 sort of area and well above that post-COVID high that we put in around 2021, right? So, but ultimately, you need to look at the broader set of data here and going back to 2000, when this chart becomes not as impressive. Now, you could say, looking at this chart myself, I have checked out this data. You could say that, well, this is actually quite a concerning chart here, but ultimately, is it going to be tradable information? It's one of those things that even if that this is going to go to 0.5%, over that 2010 high, what's the trade? what is the trade? There's no trade to do there. What are you going to short the S&P right now and hold it forever? Well, good luck with that. And then another one here: median home prices are sharply contracting. Now, this information does check out, and you're seeing here that the median house prices are contracting to levels we haven't seen since 64 actually. And this is quite concerning here, that while these interest rates are going higher, albeit a lot of those housing rates are fixed, and they're fixed at lower levels than we have right now, but with this dynamic going on, you do have these house prices contracting. So what does that mean? It means negative equity for householders. So look, I've gone on a bit about that too much. There's not really a lot of tradable information in here, but good to know, and stuff you should be definitely tracking on your radar. All right, let's get over and have a look at the charts here. And there we go. All right, I said I'd look at these sort of higher time frame VWAPs, and here's one. We use this all the time on all of our markets, and we're going to be getting into the business here of releasing a report weekly where we look at about 35 markets on their higher time frame VWAPs and how they're trading relative to that. And essentially, it's as simple as this: center VWAP on the year is average pricing for this periodicity, right, of the year. All right, and then we have one deviation, two deviations, okay? And we kind of trade around this, and we trade with this and against this sometimes. But essentially here you're seeing that oil cannot hold around that one deviation, 78.15s at today's price. Can't hold there, rejected. We've been waiting for this rejection to come in, and this is essentially why we're happy in the shorts here on the front one spreads, looking for that 2018 non-back adjusted. All these levels are non-back adjusted, all right, just to keep consistency on the levels. Looking to pull back to that 2018 non-back adjusted high, 76.90s, and you know what? We're nearly there. We're nearly there. And what I tell the guys all the time is that these levels are not hard levels. Like that 78.13 plus one deviation on the year, it's not a hard level, all right? You have to be really careful. You can't just put your order in here and give it unlimited risk, all right? You have to really trade and use a couple of other tools to time this. But you're seeing now, since about 10:30 a.m., we've been selling down off of that 78.13s. And let me tell you right now, destination is 76.90s, and actually below. All right, so I think over this week we're not only going to see 76.90s for sure, but I actually think we're going to come down to 75.53s area, in and around there, give it or take 20 ticks, maybe 30 ticks, but it should be in and around 75.53s. All right, you've been warned, but we are going to have seller. Be careful on oil to the downside. No, for me, there's no real longs here. There's no real long. All right, we're going to only going to have time for S&P and the Dow, and we'll probably have a look at gold and the dollar as well. All right, so here you are, same situation on the S&P 500. There is going to be resistance 51.41s if we pop to the upside here. I'll just zoom in on this a wee bit more for you, but you see we've been up on this thing, right? But essentially, I think we need to trade down onto the 50.78 for sure. Now, there will be a certain amount of buyers, like there was here and there was here, coming in on that plus one deviation, 50.77s at today's market in the pre so far. All right, so there will be a certain amount of buyers coming in to try and lift this, but these levels are usually a bit of a dogfight, and you need to filter these levels out for strength or weakness by using one or two other tools in your toolkit, and that's sort of what we do here. But ultimately, if we can't close above, and I think today we probably will close above the 50.77s for sure, but if this week you see that we can't close above 50.77s quarter, I would be short that level down to the 50.31s half, which is the prior all-time high, back adjusted all-time high. Right, this is a back adjusted high, and it was an interesting area for the market to hit. So yeah, just be aware of that 50.77s quarter. If we close below that, it's sayonara sucker, and down we go. All right, I can't really to the upside again. If we close above the 51.41 half, then I think we're a-okay to get up here and probably do 52.05, something like that. All right, so that keep an eye out for that on the S&P. But already you're seeing this morning a couple of these areas that we like to be long short of. You're seeing we just cannot get up above and trade at that 51.41 half at the moment. So I'd be looking at shorts in around there, for example, on a pullback on no data, for example. I think that's in order. So look, anything we need to come down. 50.77's quarter down here for sure. All right, and already seeing a bit of size coming in here, just below around 51.02s, and largest order on the book right now in the pre-market. Okay, that's the SPOOs. Let's see, what else are we gonna move to here? Yeah, the Dow. I actually have shorts on the Dow here, and again against this sort of 1.5 level here, it's like a 1.5 deviation on the year up here. So I suspected that we might try. This was actually the level on Friday. Yeah, that's where it was on Friday. And you can see lovely support actually came in there, and we rallied into a new high there on Friday. Couldn't hold it at all though. And when we came in towards the close, this market just got slammed back down, and we're quite weak at the moment. And so for me, I'm looking for a 38,968 to trade, and that to break, all right, to the downside. As long as we hold the market below eval area 39,248. All right, so I'd be looking potentially for shorts there, but I'm gonna scratch out if this thing has a pullback and goes for that 39,250s. I'll scratch my short, actually long before the 39,250s, and probably look to short that after the CPIs. Maybe there's a bid in here, maybe there's a long to be had, but ultimately all I know is that if we can't close above 39,105s today, this thing is gonna not only truck down to 38,892s, but it's gonna go below. That's it. Let's see, gold. Well, gold has actually hit some pretty nice targets on this cable. Gold's pretty nice targets on the upside here. And this sort of trend that we've had for quite a while. Now, this is a really ugly bear flag, actually, but this is sort of derived from this low and this low that we've got on gold. These are non-back adjusted charts. The low of November 22 to the low of October 23. And that gives us this bottom trend. And then we use that to give a channel trend on the top. So we hit that there on Friday, and now there's quite a bit of weight come in, and maybe people booking some profits here on gold, but I think we're going to trade way back down here on gold. Looking at the average value here, we are way out in front of our skis in terms of the price of oil, gold. As you can see, like we need to pull back to that 2157s, and actually when we do, I don't know if we're going to rebid. So keep an eye out for a close below the 2157s. And if we do close below that, I think in the next session, we are going to then be facing down into 2132s. Yeah, that's all I see. That's all I see. Now, added to that filter for the gold trade is your T-note bond. If you want to be long gold, you want to see the bond looking in good shape here. And what you're seeing in the bonds here, I'll just tidy this up right now. And in the spirit of what we're going to be doing the reports on, we'll be using this VWAP in conjunction with large support and resistance. And this has been a target up for a couple of weeks now. 111, 28 halves. Sell that, I think. A little bit of selling to be done here on the bonds for a pullback, and that would be gold in sympathy pulling back here to in and around, we'll call it 111.7s right now. But yeah, ultimately I think gold, because it's holding over this prior quarter high, it can T-notes, it can continue way higher here, way higher. But we just, I think, need a little bit of a pullback today. I don't think it's going to be much today, and then tomorrow we'll be into a different environment where I think if we're going to rebid on gold, which we could do to retest on the highs, because there is a big fib extension to just a couple of ticks over the current highs on gold, then that would be bonds up through the 111.28. So just keep an eye out there in the 111.28 for potential support and resistance, guys. Okay. All right, and that's about all we have time for. Bitcoin, I'll just do a quickie on Bitcoin. It's got to get up on this trend, 75,000 to trade this week. Lock it in. It's going to happen this week. All right, I'll leave it there. Have a good session. Keep it tight and stay lucky. Cheers.